Are you living on a fixed income that never seems to budge, even though everything else from eggs at the grocery store to property taxes continue to go up? It's tough to stay ahead when your retirement checks don't match the pace of inflation. But imagine if you could eliminate one of your biggest monthly bills, your mortgage, and actually boost your income in the process. That's exactly what a reverse mortgage can help you do if you qualify. Not only could you free up immediate cash flow, but you could also receive monthly deposits directly into your bank account to help cover the ever-rising costs. If you own your home outright, you've probably seen taxes, insurance, and basic upkeep skyrocket, putting a real strain on your budget. A reverse mortgage can offer extra breathing room so you can afford groceries, medication, or any home modifications you need to comfortably stay in your own space, like installing a walk-in tub or adding accessibility features. Whether you're set on aging in place or simply looking for a way to keep up with life's expenses, it's worth the conversation. Why let rising costs decide your future when you've already built the equity to fund it? Let's rewind back to 1961 in Portland, Maine. That's when a local banker invented the very first reverse mortgage to help a widow stay in her home after losing her husband. This small act lit a spark in both academia and Washington. By the 1980s, politicians were pushing to insure these loans through the Federal Housing Administration, or FHA. And in 1988, President Ronald Reagan signed a bill that gave the Department of Housing and Urban Development, HUD, the power to insure them under the name Home Equity Conversion Mortgage, or HECM, you may have heard. That's where our modern reverse mortgage story really begins. The belief was that most of the baby boomer generation would have most of their wealth tied into real estate. Turns out they were right. Allowing the now seniors to access the equity to help during their retirement has been a crucial move for so many that have taken advantage of a reverse mortgage, and maybe even you who is listening. So what is a reverse? A reverse mortgage is a special type of home loan for homeowners 62 years or older. Instead of making monthly mortgage payments, you receive money, often as a monthly payment, a lump sum, or a line of credit, while still owning and living in your home. The loan doesn't come due until the last borrower sells, moves out for over a year, or passes away. However, you still have to keep up with property taxes, homeowners insurance, and maintenance. Miss any of these, the lender could demand repayment sooner. The interest is added to the principal balance. So instead of making the payment, your balance grows, but you're never required to make a payment. This can be a game changer for those on a fixed income. Now, you do have the ability to make a payment, but you're not required, and most people do not. So let's start by chatting about the different kinds of reverse mortgages you might come across. There are two main types that we're going to focus on today, but really we're only going to focus on one. Single-purpose reverse mortgages. These are typically offered by certain nonprofit organizations or local government agencies. Because they're designed for a specific use, like paying property taxes or handling important home improvements or repairs, they're usually less expensive overall. However, because they're limited to approved expenses, they may not meet every homeowner's needs. In fact, I rarely see them, and truth be told, I don't think I've ever seen one actually completed. The HECM, Home Equity Conversion Mortgage. This is by far the most common type of reverse mortgage because it's federally insured by the FHA. A HECM can be used for a variety of things, such as supplementing monthly income, paying for medical costs, or funding home improvements. We'll be focusing a lot on HECMs because they're widely available and recognized, and they also come with built-in consumer protections, and that's one of the most important things that you seniors need to know. So, how do you know if you might qualify for a reverse mortgage? Well, number one, you need to be 62 years or older and have enough equity built in your home, often at least 50%. You also have to live in the home as your primary residence, no investment properties whatsoever, and you'll need to show that you can keep paying things like property taxes, homeowners insurance, and relevant fees such as like HOA or condo dues. Certain property types are eligible. Single-family homes, 2 to 4 units, as long as you live in one of them, some condominiums that are HUD approved, and certain manufactured homes that meet FHA guidelines. With a HECM, you actually have several ways to receive your funds. 10-year payments, this option gives you a steady check every month as long as you continue to live in the home. Term payments, you choose a specific period like 10 or 15 years and you receive monthly payments for exactly that time frame. Line of credit, you can draw from this whenever you need it, which can be great for, unexpected expenses or emergencies. And then, of course, there's a modified tenure or modified term. These plans combine monthly payments with a line of credit, offering more flexibility. What's really nice here is that you can pick whichever option best fits your life. If your situation changes, you might even switch to another payment plan down the road, though, truth be told, there probably will be a fee to do that. Let's be very clear and honest. Reverse mortgages can come with quite a few fees. It's essential to be aware of them so that there are no surprises. Number one, mortgage insurance premium, or MIP. HECMs required an upfront mortgage insurance premium, usually around 2% of the home's value, plus a small annual premium. In exchange, you're protected if the loan ends up exceeding your home's value in the future. Number two, origination fee. The lender charges for the processing of your loan. Depending upon your home's value, it can be a few $1,000s, but it's capped by FHA at $6,000. Number three, servicing fee. This covers the administration tasks your lender handles each month, like sending out statements and managing your loan disbursements. Number four, third-party closing costs. Expect typical closing costs for things like an appraisal, title search, recording fees, credit reports, and so on. Any fee that you typically would see on a regular forward mortgage, you're most likely going to see on a reverse mortgage as well. The upside is that all of these fees can be rolled into the loan, assuming you don't exceed the maximum loan amount. So you're not paying them out of pocket right away. Of course, that also means that they'll reduce how much you're going to end up in the end, though. Now, let's look at the big reasons why many senior homeowners consider a reverse mortgage. Number one, extra retirement income. Maybe Social Security or your pension just isn't enough. A reverse mortgage can help fill that gap. Number two, no monthly mortgage payments. You can potentially pay off your existing mortgage with a reverse mortgage proceeds, which frees up your monthly budget. Just remember, you still have to keep up with your taxes, insurance, and any home maintenance and HOA fees. Number three, flexibility. The funds can be used for nearly anything, like medical bills, home renovations, or even helping a family member out financially. But it cannot be used specifically for investments. That's one of the documents that they'll actually make you sign. You cannot utilize a reverse mortgage to either buy investment assets like stocks or bonds or even other investment properties. Number four, non-recourse feature. With HECMs, you or your heirs will never owe more than the home is worth when the loan comes due. So let's say, for example, the home is worth $200,000, and when you pass, the home passes on to your heirs, but you owe $300,000. Well, that $300,000 is not, that $100,000 difference is not due from your heirs. The home simply goes back to the bank and they're free and clear. Now, if the reverse were true, if the home was valued at $300,000 and the loan has a balance of around $200,000, that $100,000 of equity, that can be passed on to the heirs. They can sell the house. They can refinance the house. You do not lose any equity in the home. I think that's been a common misconception for a lot of folks and a lot of heirs that don't quite understand how a reverse mortgage works. Of course, reverse mortgages are not a perfect fit for every situation. Here are some potential drawbacks. Eroding equity. The loan balance grows over time. That means the equity you've worked hard to build, it shrinks, which can affect what you're able to leave your heirs. Upfront and ongoing costs, all of these, origination, mortgage insurance, and so on, they add up. Effects on need-based benefits. If you rely on programs like Medicaid or supplemental security income, the extra funds may alter your eligibility. So you'll definitely want to do some research or talk to a professional. Foreclosure risk. Yes, there is a foreclosure risk. Remember, you have to continue to pay your property taxes, homeowner's insurance, and maintain the home while you're living in it. Skipping these can lead to the loan being called due. If you're still curious, let's walk through the process so you can know what to expect. You got to go through counseling. Before you can apply for a HECM, you're required to complete a session with a HUD-approved counselor. They'll explain the pros and the cons and fees and possible alternatives. Application and financial assessment. The lender reviews your credit and finances to ensure you're able to keep up with those taxes, insurance, and HOA. We will require some income documentation like Social Security, award letters, pension letters, bank statements. There are a few documents that will be required in order to get you approved for that reverse mortgage. Property appraisal. This confirms your home's value and ensures it meets necessary standards. It's the collateral. It has to be appraised. They cannot go off an appraisal from when you purchased it 6 years ago. Underwriting and approval. The lender evaluates everything and decides whether your loan is approvable. Closing. You sign a mountain of paperwork, and it is a lot of paperwork, I'm not going to lie, and that finalizes your reverse mortgage. Getting your funds. This is where you choose how you'd like to receive the money. Monthly payments, line of credit, lump sum, or a combination. Typically, we're going to have a real clear understanding of what you're going to move forward with before closing. Repaying the loan. The balance is due when you or any co-borrowers sell the home, move out permanently, or pass away. Typically, the home is sold to repay the lender, though the heirs can pay off the balance in other ways if they want to keep the property, like refinance or pay it off in cash. But they absolutely can keep it, assuming that there's equity in the property. So, is a reverse mortgage right for you? It all depends on how long you plan to stay in your home, what you need the funds for, and whether you're prepared to handle ongoing expenses like property taxes and homeowner's insurance and HOA. If you're leaning towards this option, it's wise to consult with a professional. Please do me a favor. I'm happy to sit down, get on the phone, and discuss this with you. We can offer personalized guidance and double check that your new loan won't jeopardize any of your benefits that you count on. No matter what, it's always smart to do your homework. Ask questions, understand the fine print, and compare your options, because a reverse mortgage is a huge financial decision that can truly shape your retirement. Reverse mortgages have come a long way since that first one in Portland, Maine, done in the 1960s. Today, they're highly regulated, offering peace of mind, but also they carry serious responsibilities. If you're curious about whether you can turn your home equity into a retirement solution that you've been searching for, talk to me or somebody on my team. We'll help you weigh the costs, the benefits, and the alternatives, so you can decide if a reverse mortgage is your golden ticket or just another financial pitfall. As always, thanks for watching. Be sure to like, subscribe for more insights into the retirement, real estate, and everything home finance. My name is Darin Hunter. This was another Guaranteed episode.